Welcome back to Midday. We have Mark Bertoli joining us from Abbott Wealth Management. Mark, it's great to have you back on the show.
Thank you.
Yes, and Nicholas, my son, is here to help ask the hard questions today.
Fantastic.
I know, yeah.
You know, if Nicholas listens and starts investing his money, then you and I can retire and he can take care of, you know, all of this.
Do you know that I was talking to him actually earlier about the fact that if he only invested like $20 a month right now, he'd be retiring well before all of us.
Amazing. Yeah.
So you're going to make an appointment with Mark when we get off the air.
There you go. And we do that.
I know.
Yeah.
And you know what? Honestly, there's some valuable advice to be said about investing early. But today, we're talking about the markets and we're comparing price-earnings ratios with two companies. So
well, you know, last time I was on, I talked about Netflix and Amazon and Facebook and all the companies that were leading the U.S. hire. So I thought today I'd dive a little deeper.
Okay.
So and give you some world examples. So Carnegie said in 1930, I don't know why they call it common sense because there's nothing common about it. So we're going to look at that today.
Sounds really good.
So let's bring up the first chart, and where we're at year to date, and it kind of tells us a little story here. So the S&P 500 in the US is at about 15% growth so far this year. Contrasting the very bottom, the TSX, our Canadian market, is only up 4.83. There's a couple others in there. Financials in Canada are doing quite well at 8.7. And energy, as you can see, is down about 12%. Probably the value leader and the star over the next 3 years. But I thought I'd bring a chart to try and teach a lesson today, a little bit about price earnings and the true value of a company. So let's bring up the next company here. That's Cisco Systems. So builds hardware, very involved in the internet running. Great company. Right now, their earnings are about $9.6 billion a year.
You hear that, Nicholas? $9.6 billion a year.
Yeah, profit.
That's a lot.
So what's really interesting here, you can see the spike on the left-hand side of the chart. That was 2000. Cisco had earnings of about 2.4 billion there. It was trading at 222 times its earnings. So what's really neat is if you look to the far right of the chart, that's where the price is today. So anywhere that bump on the left-hand side was above where it is today, 17 years later, those people have never made money.
Wow.
So it's a great business, but it's also very, very important what you pay for the earnings or the true value of the business. Because if you get it wrong, those people who got it wrong have still not made their money back 17 years later.
Interesting.
So we got to really, and that's a price earnings ratio.
Yes.
So the next one I want to bring up is a contrast here. This is Scotiabank, and Scotiabank, this chart goes back to 1998. You can see the bottom is the dividends, or what they pay out to shareholders who own this company.
Okay.
And the top is the actual price of the stock. So you can see that the earnings and dividends have been very regular on their growth trajectory, where the price, because of emotions in the market, the big dip in the middle was the financial crisis of 08. But if you drew a line through the average of the earnings and the average of the price, they just about mirror each other. So what that teaches us is the earnings of a company should reflect the true value and price of the company over time. So now I'm going to do a comparison. Here's where the lesson comes in.
Okay.
So here's two companies that we know.
Yes.
Scotiabank and Netflix. So Scotiabank is trading at 12.8 times earnings. Netflix is trading at 192 times earnings. In other words, it would take 192 years for Netflix to pay for itself with earnings. It would only take Scotiabank 12.8 years. Net income for the quarter, Scotiabank made $2 billion last quarter. Netflix made $129 million. So a small percentage of it, not even 10%, okay? Market cap, what are they worth? Scotiabank's worth $99 billion, and because of speculation and hype, Netflix is worth $110 billion.
Okay.
Which company do you think's a better company? You can see the earnings of Scotiabank are better. You can buy it for way less money. It's well, it should be worth more because its earnings are more than 10 times Netflix. But if you look at year-to-date percentages, Scotiabank's up 11.4%. Netflix is up 58%. Now, if we go and think back to the chart of Cisco, people who bought in that 222 times earnings part of the chart early in 2000 have still never made money. They were all excited about Cisco and the .coms and everything else, and people don't use common sense.
Right.
So if you look at the numbers and use common sense, you should be able to make good investment decisions that stand the test of time.
And it's about standing the test of time.
Dale Carnegie said, I don't know why they call it common sense. There's nothing common about it. You need to be careful with your money, understand what you own.
Yes. Great lesson for today, Mark Bertoli. Thank you for being here.
You bet. Thank you.
All right. If you have any questions for Abbott Wealth, information's on the screen as well as the phone number 372-3736. We're back after quick breaks.